There's a question almost no one asks when they open a bank account. And it's not because the answer is complicated. It's because the answer is uncomfortable. What actually happens to your money after you deposit it? Most people believe their savings are sitting safely somewhere, waiting patiently until they need it. But the modern banking system doesn't work that way. And once you understand how it really works, you'll see why large institutions, corporations, and wealthy investors have been quietly changing how they store cash. This isn't a warning about collapse tomorrow. This isn't panic. This is about understanding stress points before they become emergencies. Welcome to Economic Narratives. Let's start with the foundation. When you deposit money into a bank, that money is no longer sitting idle. Banks operate on a structure where only a small portion of deposits are kept readily available. The rest is put to work, loaned out, invested, or parked in long-term securities. This structure functions smoothly under one condition: stability. Stable interest rates, stable confidence, stable withdrawal behavior. But stability is exactly what the system lost beginning in 2022. Interest rates didn't rise gradually. They surged at one of the fastest speeds in modern history. In a very short window, the cost of money changed completely. And here's the key detail many people miss. When rates rise sharply, assets that were purchased in a low-rate world instantly lose market value. Banks across the country loaded up on long-term bonds and fixed-rate securities during years of near-zero interest rates. Those assets are still there. They didn't disappear, but their market value is far lower than what banks originally paid for them. That difference is what we call unrealized losses. As of recent data entering 2026, hundreds of billions of dollars in unrealized losses remain embedded in U.S. bank balance sheets. Lower than the peak, yes, but still large enough to matter. Why does this matter to depositors? Because unrealized losses don't stay unrealized if banks are forced to sell assets. Banks borrow short and lend long. Deposits can leave instantly. Assets often cannot. If withdrawals accelerate, banks must raise cash. To raise cash, they sell assets. And when they sell assets in a high-rate environment, losses become real. We saw exactly how fast this cycle can unfold. In early 2023, a major U.S. bank went from well-capitalized to insolvent in days. Not because its assets were toxic, but because confidence vanished faster than liquidity could keep up. Digital banking changed the speed of risk. Withdrawals no longer take weeks. They take minutes. And once confidence breaks, math takes over. Now let's talk about insurance, because this is where many people stop thinking. Yes, deposits are insured up to $250,000 per depositor per bank. That protection matters. But the system assumes something very specific. Not all banks experience stress at the same time. The insurance fund itself represents a very small fraction of total deposits nationwide. It works because failures are supposed to be isolated, not synchronized. When stress spreads across multiple institutions simultaneously, the system relies on confidence, coordination, and emergency measures, not unlimited cash reserves. Insurance protects balances. It does not guarantee immediate access. And timing matters more than people realize. A short interruption in liquidity can be devastating for households and businesses alike. Now layer in a second pressure point that's been quietly building. Commercial real estate, office buildings, retail spaces, large developments financed during a very different economic era. Remote work permanently changed demand. Property values adjusted downward. And now trillions of dollars in commercial loans are reaching maturity. Refinancing those loans at today's interest rates is far more difficult, and in many cases impossible. When borrowers can't refinance, banks don't just lose interest income. They inherit assets no one wants. This creates stress on top of stress. Lower asset values, higher capital requirements, reduced lending. And that brings us to regulation. New global banking rules require institutions to hold more high-quality capital against risk. To comply, banks reduce exposure. They lend less. They conserve liquidity. This is one reason credit feels tighter than it did years ago, even for qualified borrowers. None of this means the system is about to implode, but it does mean the margin for error is smaller. So how do you evaluate risk without guessing? There are 3 indicators worth understanding. First, capital strength. This shows how much real loss-absorbing capital a bank holds relative to risk. Second, asset quality versus equity. This helps identify institutions that could struggle if losses accelerate. Third, the proportion of uninsured deposits. Banks with a high percentage of uninsured funds are more vulnerable to rapid withdrawals. These numbers are public. They're not secrets, but most people never look. Now here's what sophisticated money does differently. It doesn't assume one institution is always the safest place. It doesn't concentrate everything in one account. It diversifies custody, not out of fear, but out of discipline. Some funds are spread across multiple banks. Some are placed in government securities held directly. Some sit in highly liquid instruments designed to minimize duration risk. The strategy isn't prediction. It's resilience. And that's the core message here. This period isn't defined by bad actors or reckless lending. It's defined by speed. Rates moved faster than balance sheets could adjust. Technology accelerated behavior, and confidence became more fragile as information moved instantly. The system can function under pressure, but pressure changes incentives. At economic narratives, the goal isn't to scare you. It's to explain the mechanics that operate quietly in the background. Most people will never experience a bank failure. Most institutions will navigate this environment successfully. But most is not the same as all. And awareness costs nothing. Know where your money is. Understand how it's protected. Avoid unnecessary concentration. And stay informed as conditions evolve. Financial systems don't collapse because everyone panics. They strain when assumptions stop matching reality. Preparedness isn't pessimism. It's literacy. And literacy is the difference between reacting late and adjusting early. If this kind of breakdown helps you see the system more clearly, subscribe to Economic Narratives, because understanding the story behind the numbers is how you stay ahead of them.